Hello, this is a video of lecture 12 of Energy and Resources Events and Models. I'm going to start in the lecture 12 folder, which you have, and we're going to be looking at non-renewable and renewable energy and resources and how those can be managed and some strategies that can be derived using system dynamics modeling. I'm going to fire up Vensim. Let's look at the non-renewable case first, and so this is a model that you have in your folder, so I'm going to stretch this out. And let's take a look around the model. Basically, the idea of this model is to show that when you have a resource that is non-renewable, it is difficult to manage it without having either a dose of recycling, which we have included here in the model, and I'll walk you through it, or by expanding the reserves of that model. So we're going to see that a little bit by looking at a relatively simple model that has three stocks. I'm going to start with the bottom one, the demand for the resource, and this resource could be oil, could be coal, it could be a mineral. Okay, and for the most part, I'll try to refer to the oil case because that's fossil fuels in general, because those are the cases that are for which this kind of models is most applicable. Now those resources are used, and there's a production rate that goes into their use, and there's a discarding rate that happens after you use the product. There may be a fraction of that discarded resource that can be recycled, and then here we're also keeping track of the cumulative resource consumption because we can compare this to the reserves. So let me walk you through the entire model. Let's look at the equations field. This particular model has an original resource reserves that are given in units of metric tons, and just for the sake of an argument here, we're starting with 100, and that's the original size, or the size of the reserve of the resource. Okay, that triggers the computation of a availability ratio, and this basically tells you what's the fraction of the original reserves that are still available, and the available resources are computed as the original resources, that 100 number that I showed you, minus whatever is consumed over time. Okay, so that's fairly straightforward. I added a max here just to prevent the availability ratio of going negative. Like, for example, if you push the model and you run into a situation where you consume more than you originally had, this essentially stops running the model, and or gives you a flag error. Okay, so let me see that, and so this availability ratio allows you to compute a scarcity index. Now this scarcity index is used primarily to sort of set a boundary of like a flag that tells you that you're running out of resources. And so I introduced here that the model should run as long as there is an availability ratio that is greater than 5%. So if your consumption reaches more than 95%, that basically means that you've essentially run out of the resource for all intents and purposes. And so that scarcity index is calculated as the inverse of the availability ratio. Okay, so a higher scarcity index means that your availability ratio is very small, so it's the inverse. And I capped it at 20, which is the inverse of 0.05. So that's sort of the limit. That's the highest possible value. This scarcity index is between 1 and 20. Okay. Now the scarcity index helps trigger what we call a resource recycling share, and this is essentially the need, establishes the need for resource recycling. And I put it here as a table, but you can actually look at it as a graph. So let's take a look at that. And essentially, this is a small table. You have the scarcity index in this column, and this is the fraction of the resource that should be recycled. And all this is saying is that as you run out of your resource, there is a bigger need for recycling. So that when you are at 20 for the scarcity index, and remember this would imply that you're down to 5% of your resources, then you should be recycling 95% of the use in order to be able to continue going. Okay, and now I want to talk a little bit more about recycling. So I'm going to get out of this because we have a recycled resource here, which is a variable, and that variable it's computed based on the discarding rate, which I'll talk about in a second. That comes from the second stock, 2 times this resource recycling share, which is the value that's read from that table, from that graph. And then we have here a switch that is it's called recycling 0 or 1. And I'll tell you what this is about. This is just a variable here that's either 0 or 1. So if right now I have it at 1, that means that you are recycling. If I put that to 0, 0, that will mean there's no recycling at all. Okay, and you can play around with having recycling or non-recycling, and in some cases, with some resources, you can actually do some recycling. With oil, with coal, recycling is somewhat limited, but you could recycle, and you can recycle oil products. You can recycle coal products, but it's limited, so I'm going to leave it back at 1 because we can then turn back and run it with 0. Okay, so let's go to the second stock. We're still here. So the exploitation of the resource, it's computed as as a product of the demand for resource, which is one of the stocks, minus what's recycled. So whatever resource you need minus what you can recycle, that's what you actually exploit. And you multiply that by the availability ratio just to consider the fact that you don't have unlimited reserves. So the resource exploitation pays attention to that factor. Okay, so to the factor that this availability ratio has an impact here, and then the cumulative resource consumption is simply the accumulation of that resource, of the exploited resource. So this keeps track of how much you have actually exploited, and you can always compare that to the original reserves, and we'll be doing that. So let me go to the second stock here, resource in use, and the resource in use it's a differential between what's getting produced and what's getting discarded. Okay, so let's take a look at let me take a look at this equation first for the stock. So this is essentially just the production rate minus the discarding rate. Okay. It has an initial value here that you can compute as the life cycle times the initial resource demand. And I'll talk a little bit about these variables here as well. Let me talk a little bit about the discarding rate, which that's the sort of the easier one to look at. And this is the discarding rate is computed as how much resources you have used divided by the used resource life cycle. And this is if you imagine that when you develop an oil product like the oil that you put in your car or the gasoline, these products have life cycles. So if you take the resource that you're using as a whole and you divide it by that life cycle, this gives you an idea of how much what's the rate at which you discard these products. Now, a fraction of this discarding rate gets recycled. Okay, so if you go back, like we did before, to the recycled resource, the discarding rate is there. So not all of this product is completely discarded. Some of it is recycled. The production rate that feeds into the resource in use, it's the addition of 2 factors. It's whatever you're able to recycle, okay, and then whatever you're actually exploiting. So those 2 add up to the production rate. And then you have the used resource life cycle here, And in this case, we've put a value of 10 years. You can play around with that value if if you want to look at strategies in which you have longer or shorter life cycles for your product, so you can look at how that impacts the management of the resource. So that takes care of the second stock, and then the last stock is the actual resource demand, and the resource demand is fed by a growth in the resource demand, and there's an initial resource demand. The initial resource demand that goes into that equation is 5 metric tons per year, just the value to get things going, and the growth of the resource demand, it's essentially computed as the actual resource demand. So it's you have a growth right there, and here what you have, it's essentially it's like a carrying capacity. You have a 1 minus, and then you have the resource demand divided by the initial resource demand times the max demand factor, and this max demand factor is like your carrying capacity. It's the maximum amount of that resource that you can actually extract from the system at any given time. Okay, and then the consumption increase today. This is the rate, and you divide it by 100. So because it's given as a percentage, so this is essentially this whole formulation. It's like a carrying capacity formulation that we've seen before in the consumption of other resources, so that this basically introduces into the dynamics of the resource demand the fact that there is a carrying capacity for that resource. Okay, so you have the interaction of these three stocks if you run this model, and what you see here, I sort of tailored the two graphs into the results. The first one has its 3 stocks. It has the resource demand, the resource in use, and the cumulative resource consumption. And one thing you can see here is that the demand grows over time. Okay, the resource in use actually decreases over time, and the reason that happens is that you can actually look at the cumulative resource consumption. Is that you're essentially over time you're running out of the resource, and you actually get to a point where you reach your 100 metric tons, which was the reserves. Okay, so this decrease in the resource in use comes about because you're actually running out of the resource. And remember, the resource in use is driven by this availability ratio. If you we can look at also at other resource use indicators. Here you have the availability ratio, which is the blue line, and the availability ratio drops down, as the resource get depleted. You have the recycled resource, and in the beginning here, you're actually doing a pretty good job of recycling, and you're recycling up to in the middle of the simulation, you're recycling up to 3 metric tons per year, which is pretty high compared to the rate at which you're demanding, which is 10. So you're sort of getting 30% at the best, 30% of your resource from recycling, but that actually starts dropping again because you start exploiting less, and then the scarcity index shoots up very quickly as the availability ratio comes down. So you can play around with this model. I mean, there's several things you can do, and think about how if you wanted to have a situation that was more or less sustainable. I want you to play with this model and tweak some of these parameters. Play around with the size of the reserves. Okay, that's one. With the recycling, and I'll quickly make a run here with 0 recycling just to see what the impact is. But play around with the recycling, and play around with the life cycle of the products, and try to see if you can come up with a strategy that would allow you to have a sustainable situation. Sustainable meaning that you don't have things topping up or going down to 0. Something that will balance out and get steady over time. And it's going to be a challenge because it's and I'd like to see you look into what parameters, what combination of parameters will allow you to achieve that sustainable situation. And it's going to be interesting. But let me make a quick run before we finish this video by tweaking the recycling ratio from 1 to 0. Okay, just to say, well, there's no recycling, and let's run this again. And yeah, let's overwrite, no problem. And then what you have, it's actually, well, you can see here that things are, are just starker. Your resource demand goes up and continues to go up, but you reach, you sort of top out your resources much faster, and of course so this is more like almost like a collapse scenario that occurs very quickly, and you can actually see that same here in the use indicators. The scarcity index goes to 20 very quickly, which is the maximum, and then the availability ratio drops faster. So here, non-recycling, it's not a good option for sustainability. So I think the options that you explore for sustainability are going to have this switched back to 1, and you can play around with other parameters. So please look at this model, play around with the parameters, come up with ideas as to how to make a non-renewable resource exploited in a sustainable way, and let's see what you can come up with. So that's the challenge that I throw at you, and please post your results on the discussion page, and let's see what we get. Okay, so I want to move on to a next video which deals with sustainable management of renewable resources and see what the differences are there. All right, so I'm going to switch off this. Thank you. We are back here in the Lecture 12 folder, and I want to look now at the renewable resource model. And let me expand this a little bit, and let me walk you around this one. So the idea here is that now we have a resource that's renewable, okay, and that's it's being consumed, it's being used, it's being exploited. Now, this renewable resource actually there is a regeneration term. So think about a renewable fuels so that they can be that regenerate naturally, or they can be regenerated or created. Okay, so this renewable resource gets consumed, it gets regenerated. The renewable nature of this resource, it's used to calculate an annual production of the resource, which generates an expected rate of profit given a resource price. So this is a resource that you're selling, but also this renewable resource drives the investment that is required to use that resource for production. Okay, and then that production will have some operating costs. There'll be some revenues from the sales of the resource, and that operating costs and the revenues are used to compute profit, and you can actually keep track of the profit that's accumulated. Okay, there are some other variables that are introduced here, so I'll walk you through the model and through the different equations. So let's start first with the first stock, the renewable resource stock. And if you look through it, it's basically the difference between regeneration and consumption, and it's got some initial resources as the initial value. Okay, the units are in tons, or T, simply in T, and in this case, and there's an initial value here of 1. Okay, and the renewable resource gets regenerated. The regeneration here, it comes from, it's influenced by a couple of things. There is a maximum resource capacity, and that is a value. There's a value of 1, so that's it's like the reserve concept that in non-renewable case, but it's not really a reserve like in the non-renewable resource case. This value is more of a threshold that indicates that this is the maximum amount of this resource that can be available on any given time, even though it's regenerated. So if you think about a wood, like such being a renewable resource, this could be in a forest. This could be like the maximum amount of wood at any given time in that reserve, but it's not really it's a renewable reserve rather than a non-renewable one. So that's a difference with the case for oil and coal that we saw before. Another variable that comes into the regeneration is the regeneration rate. And the regeneration rate, it's a we'll see here, it's driven by an erosion limit and a normal resource regeneration rate. Let me take a look at those first. This normal regeneration rate would be the regeneration rate in the absence of resource depletion. Okay, so this is like the natural resource rate. Here there's an erosion limit that's introduced, and the idea is that if you look at the actual regeneration rate, then it tells you that if your renewable resource falls below some limit, which is we're calling that the erosion limit, then you really do not regenerate. So there's a bottom threshold to the regeneration rate of the resource. Otherwise, if that doesn't happen, then you're always regenerating at the natural rate. So that takes care of the regeneration. Let's look at consumption of the renewable resource. And the consumption is equal to the annual production. And the annual production here, it's computed as the renewable resource multiplied by a couple of things. In order to produce, you need some capital, some production capital that comes from one of the other stocks. And there's a specific production rate variable here. This specific production rate, and if you look at it, this is the tons of the resource per unit ton that can be produced per year and per unit of capital investment. Okay, so this is essentially a reflection of how much production there can be. Okay. So consumption is going to depend on that annual production here directly. Okay, now let's take a look at the variable at the stock variable production capital, and that's going to take us to talk about investment. And so the production capital is essentially equal to whatever is invested, and there's an initial production capital here to initialize things. If you click on it, it's $0.01, so it's a cent. So this is not using any real case, but it's actually more like a relative model. Now let's take a look at the net investment, because this is where the production capital gets originated. And there's a few variables that feed into it. So let me walk you through the and there's an explanation here that I put in just to clarify what the variable was. So essentially, a fraction of annual net profits are reinvested into production. Okay, so this is a production in which you generate some revenue and there's some profits, and a fraction of those are reinvested into production. This fraction is calculated as the ratio of the actual investment to the expected profit. Okay. And is modulated by the availability of the renewable resource. And this is important. So whatever you're reinvesting or whatever you're using to produce considers not only the financial benefits, which is this ratio of actual investment to expected profit, but also the availability of the renewable resource. Now, the availability of the renewable resource is found as the relative difference between the renewable resource stock and the maximum resource capacity, considering something called the safety factor. So let me walk you through what this is. Essentially, what you have here is that your net investment is going to be your annual net profit. So that's what you start with, and you're gonna take a fraction of that. The fraction of that is composed by two things. There is a ratio of the investment rate to the expected rate of profit. So this is essentially, you sort of invest if your profits are, if you're obtaining a lot of profits, you're able to invest more, but there's an expected rate of profit that you can compare to, and we'll see that in a second what that means. And then here you have a relative ratio. You have the renewable resource, which is a stock, divided by the maximum resource capacity times the safety factor minus 1. So this is essentially a relative. This fraction here, this is a relative, the relative availability of the resource compared to the maximum resource capacity attenuated by a safety factor, just so you don't push your resources availability to 0. Let's take a look at the safety factor here to start with. And the safety factor here is 50%, 0.5. This means that if you are in a situation in which you draw down your resource down to 50%, this triggers essentially this indicates that you're running low. Okay, and you can tweak this number, safety factor, around a little bit, but what we'll see is that if you start pushing this too low, essentially if you start taking more and more risks in exploiting this resource, you can run into a situation where you can collapse, and that can happen. The investment rate here is given as a essentially dollars per year, so it has units of 1 per year. So this is how much money you invest. You're investing at 10% of your profits per year, and the expected rate of profit that's given here, it's essentially what you would expect to get if you were to utilize your maximum resource capacity. So if you were to sell it all at a resource price that's given, how much you can sell your resource for, and the specific production rate. So if you can produce using your maximum resource capacity and sell it at the resource price, this would be your expected rate of profit. So this is sort of the maximum amount of money you can make on a given year by selling this. Okay, so all that goes into this net investment, which produces capital. Now, the production of capital generates some operating costs. So there's the production capital multiplied by how much does it cost to run the operation per unit capital, which is this specific operating cost here, and then you have the revenue, which is generated by multiplying the annual production, whatever you get to produce, times the resource price. This will give you your revenue, and the revenue minus the cost will give you the profit. Okay, and you can actually accumulate the profit and keep track of it over time. Okay, and there's a 0 initial value for the profit. Now the profits get recaptured into the investment. So that's how you actually get this net investment ratio back. Okay, so you compare your annual net profit to your expected rate of profit, and then this gives you that ratio that's repeated here. So the general idea is that you would have your net investment driven not only by expected rate of profits, but also factoring in this maximum resource capacity with the safety factor, and that sort of tampers or modulates the how much money you put into producing capital to generate revenue and operating costs. So if we take a run of this model, and I say yes here, and I essentially plotted here the essentially 4 variables, the 3 stocks, the renewable resource in blue. So you can see the renewable resource, it starts at 1, and then it sort of goes down, but it reaches a plateau over time. So you sort of get into a sustainable situation. The production capital does a little bit of the same. You start, this is in red, you at the beginning you have to invest low because it's a lot of resources, but eventually it sort of tapers down and becomes stable. The annual production here I plotted just to show how much was being essentially extracted or consumed, and again it goes up for a little bit at the beginning, and then it reaches a plateau, and then the annual net profit, which is so those values also stabilize. So this is a sustainable scenario, and I want you to look at it, and you can actually play around a little bit with the with the parameters. I would start with a safety factor, for example, and look at also the maximum resource capacity and see what you can do. And if if you want to increase your profit or reduce the resource consumption or reach a higher level. So try to look at how these variables interact by running this model. There's a separate model that I put there that I called it unsustainable. I'm going to let you look at that individually, but essentially it's the very same model as this, except that I removed the linkage between the maximum resource capacity and net investment, basically removing then the modulation that the resource capacity or the resource availability has on how you invest. I'll make a quick video of it just to, I won't run it, but because I want you to play with it and tell me the differences between when you do one strategy versus the other. When you consider resources for investment, or when you base your investments only on profit expectations. Okay, so I'll leave this video here and I'll allow you to play with it. I hope you enjoy it. I wanted to quickly show you a model of unsustainable resource management. So let me open this model up in Vensim and just walk you around the model itself. And basically this model is exactly the same as I showed you before for the renewable resource management. It's you can look at it, and it's got the same 3 stocks and most of the same variables. The only difference is that when you look at the net investment component here, see there's no link between the capacity of the resource and the net investment. So in this case, the investments in capital do not consider the availability of the resource as a factor. There's no modulation of production based on resource availability. And that's a key difference, because essentially what that means is that your net investment in this case is only driven, and I'll let you walk around the variables, it's only driven by a difference between a profit expectation here and the annual production or the revenue, which creates a discrepancy between expected profits and actual profits, and that drives net investment. So net investment is only driven by by the financial characteristics of the system, but not by the availability. And what you're going to see then here, you can actually run this model, is that you can get into a situation where the resource is not going to be sustainably managed. So I'm going to let you do that. I want you to run this model and post any insights on our discussion page. Also, in comparison to the previous model, the model B, this would be model C, in which you do have that linkage between resources and investment. Okay, so I'll let you run with this and post any insights on our page. Okay, thank you.